What's up, good people? How you doing? Welcome back. Stock Up with Larry Jones. You already know to hit the like, subscribe, notification bell. Listen, I'm going to be talking shortly. Let me rephrase that. I'm just going to be sharing with you some of the stuff that is going on why Fed Jerome Powell is talking. This is going to be short, and I'm just going to air the remaining balance of this meeting. I didn't want to stream as long as he's talking. But I want you to look at this. As you could see here, they should be wrapping up now. You can see the Dow and all of the indices are tanking. And so why is it tanking? I believe it's tanking because Fed Jerome Powell is speaking. As you can see, the markets are tanking. And if you look here to this heat map, now this is on Moomoo. This is on Moomoo. If you don't have Moomoo, download the second link below. But look at this. This is the heat map. It's showing you everything that's red. Look at this. Take a pick. Internet, drugs, oil and gas, semiconductors, and are just one of the few in internet retail. If I can read that right, I'm reading it from across the room. Those are the only two sectors that's green. Look at this. Insurance, auto, banks, credit, biotech. Anything that you wanted to buy. And if you think that Fed Jerome Powell talking today is temporary to the market, which I do, you can find some deals out there. There again, I'm looking at energy. I'm not telling you what to buy. Me personally, I am looking at energy. And I'm looking at oil in specific. You take your pick. I just put a few of them up here to keep an eye on. EOG, Exxon, Pioneer. Here you have Devon. You got Chevron. Look at that. Look at that. And so these are the ones. EOG really went down this morning. It really tanked this morning. So I look for opportunity, good people. I look for opportunity. And I know there's other ones out there. People say, hey, why this? Why not that? You go with what you think. But me, I just have, if I have a gift that keeps giving, I'm going to keep coming to the gift giver. And that one has been that. So I'm going to diversify and buy more. But I'm doing options. I'm going out. There again, I'm going out to March 6th. And I'm also March 24th contract at $123. That's just me. And then I went out to April 6th. And that's $124 strike price. And I'm just trying to get it at the cheapest. So I buy one and I just keep adding to as it goes down. All right. And on days like this morning, I was down as much as 26% on my EOG. And what did I do? I bought another one. Now I'm only down 12%. And I do believe that the biggest threat to the market will be CPI and PPI, right? Those are, I think that's the 14th and the 15th. And so I believe that I can make some money. Scared money don't make money, all right? Now, me personally, I'm not setting any stop losses on these right now at this point, all right? So you tell me, what do you buy? Not just options. You tell me, where do you see a opportunity to make money on days like this when the Fed is speaking? He's on the Hill. You got Dems and Republicans that are hammering him. And as you could see, now the Dow's down by 400 points. Okay. So me personally, I look for opportunity. I didn't plan on going live today, but these type of deals are opportunities for me. And so I see I can get in, make a little money, and then get back out if the market rises back up. I don't believe that this is the drop. I just don't. It could be. I'm not a fortune teller, but I don't believe this is the drop. I believe that this is a drop, and I believe we will have some green days this week. I just believe that. Now, if they're all red from here, then I'm just telling you, this is just a thought. I don't have a stack of sheets that says this is not the bottom. So you have to trade according to what you're doing. Now, I am in a live trade that I'm going to be posting in the class. I'm doing that over a few weeks, but it just takes time to go through the process. But you guys tell me what you think. What do you see out there? Do you see anything that you are buying today, right? Yeah, it's tanking. Yep. Yeah, looking forward to that drop. Yeah, man, I am, listen, right now, I am absolutely sure that I just want this to be over with, pull the Band-Aid off. And now the Fed is in a position where he doesn't want to cause the deep recession, right? So he's in a tricky spot. The fact of the matter is that the longer it goes, the worse it's going to be. And I would rather us, for those of you that's only been trading for a while and you hear the term rip the Band-Aid off, I would rather him rip the Band-Aid off. Look at the S&P gainers. You see that? You could see the gainers. So, and as you can see, the Dow is fighting around negative 400. There's a lot of opportunity that you could see when the Fed is speaking. Always pay attention to what sectors are green, what sectors are red, if you're an opportunity investor like I am. But I want him to just go ahead and rip the Band-Aid off. Let's have a soft recession and get it over with, because it's coming. We don't know exactly when. First half of the year, we don't know. Second half of the year, we don't know. Is it going to go into Q1 of next year? We don't know. No one knows. But we do know it is coming. And so I'd rather him rip the Band-Aid off, meaning just go with a aggressive interest rate hike, cause the market to do what it's doing. And it's better for him to do it now while the market is strong enough to take it. But when jobs when unemployment is spiking up, and the market is weak, then it's gonna hurt worse, good people. That's why. So for those of you that think, oh, he's just salivating, waiting on a recession, a deep recession to come, there's a reason why it's better for you and me. And the market has to reset, whether you want it or not. It has to. All right. So I'm going to be back with you this afternoon, and right now I'm just going to play the remainder of the Q&A, and then we're going to hear a little commentary after that, and I'm going to let you guys listen. For those of you that are at work, I didn't plan on being live today. Make sure you check out the three top links below. Right? Peace.
On people and our economy, I was wondering if you would just be willing to update us briefly on some of the next steps that the Fed is going to be looking at as you evaluate the resilience of financial institutions with respect to climate risk. There's this pilot project that just was started in January, I think it was, of this year, and I'm curious to know how you see next steps there.
So we're doing really two things. One is we are doing a climate stress scenario,
yep,
which the banks are already doing, the large banks, the 6 that we're working with, and that's really just to begin the process of understanding the risks that are associated with this over the longer term. They're already doing it, and it's something that there's a lot of learning going on around the world, actually. The other thing we're doing is providing guidance. The banks want clear guidance. They actually want one set of rules globally. The big banks that do business around the world, they're hoping that they aren't in a world where there's just different regulatory regimes everywhere they go. So we're kind of working on that as well.
Great. Thank you very much, Mr. Chair.
Thank you.
Thank you, Senator Smith. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being here. In your opening statement, I was here for that. I think you touched on some of the interest rate sensitive components of GDP and non-interest rate sensitive components of GDP. I think you said that we do have a concern in the latter group: inflation expectations, labor market tightening, et cetera. Can you tell me a little bit about how you're looking at the interest rate sensitive and non-interest rate sensitive readings, and whether the Fed, what sort of Fed actions can take place to avoid a zero landing?
Sure. So on the housing sector, of course, is intersensitive spending is the thing that they're very directly affected by our policies almost right away. And the poster child for that is housing. And so you've seen mortgage rates now go back up over 6%. You've seen housing starts come down. Activity in housing has declined as people are reluctant to get out of their the low rate mortgages they had before. So housing activity is slowing down. On the other hand, housing prices went up in the aggregate more than 40% since the beginning of the pandemic. So we may be seeing some price correction on that too. So that's coming along. And housing inflation, which is a big part of the CPI, a little bit smaller part of the PCE, the inflation measures we follow, or we rely on, that will be coming down because of the slowdown in the housing market. I guess I would say the service sector is probably less interest sensitive than that, and that's restaurants, it's travel services, travel and leisure, it's healthcare, it's financial services, healthcare services, all those services, and that's a big part of our economy. This sector is 54%, I guess, 56% of consumer spending on non-energy and food. So it's very important, and it's about having a little bit softer demand and about having some softening in labor market conditions. We think our tools will work on that, but we do expect that will take time.
Thank you. I know the chairman in his opening comments mentioned a belief, I don't want to misquote him, but a belief that we have too little capital in the banking sector. May be true of a couple of banking institutions, but how do you feel about the current capital that our broader banking sector, irrespective of where they are in size? What concerns, if any, do you have about the capital that we see out there already?
So I supported all of the capital raising that we did. I joined the Fed in 2012, and we were in the middle of implementing all those Dodd-Frank increases, and I supported all of them. After careful thought and discussion with my colleagues, I think the new vice chair is doing what new vice chairs do, which is to take a fresh look and ask the question, even though I think we all agree capital is strong, certainly the vice chair does, the question is it at the right level? And I think that's what happens with a new vice chair for supervision. We don't have any proposals yet, but at some point we will.
Yeah, I'm going to be meeting with the vice chair, and we'll drill down on that topic. But I do know, I was over in Finance Committee, so I wasn't here, but I do know that several members, well, first off, we know that Vice Chair Barr is looking at a holistic review of capital requirements. I think that's a good idea. But I have to ask a question. Do you think, does the Fed consider the bipartisan passed Senate Bill 2155, which is currently the law of the land, superior to any of the Basel requirements or any holistic review process? In other words, it is the law of the land. How does that weigh into how these reviews go?
So 2155 was, I think you're talking about tailoring. Yeah. So Dodd-Frank actually called for tailoring, and what 2155 did is it said changed may tailor to shall tailor, and it also changed the thresholds. Yep. But tailoring is an absolutely bedrock aspect of our bank regulatory system, and anything that we do is going to reflect what we think is appropriate tailoring between the different sizes and risks of the financial institutions that we supervise and regulate.
What we were trying to accomplish as a part of that, I don't expect you to respond, I know that we're coming to the end of the hearing, is that a holistic review of a financial services institution is going to reveal the fact that many of these financial institutions are very different based on the activities that they're most involved in. And those sort of holistic reviews may actually result in increasing capital requirements for two banks that look like peers, but not for another because of the inherent risk associated with their business focus. Does that make sense?
To your earlier point, though, the law, the Dodd-Frank language, and as amended, actually requires that we take those things into consideration. So we certainly will. We will.
Thank you.
Thanks, Senator Tittle. Senator Warnock is recognized from Georgia.
Thank you so very much, Mr. Chairman. Before I begin my questions, I know that this committee will soon consider a new nominee to serve on the Federal Reserve Board of Governors. And while it has not historically been the case, it seems to me that the board should reflect the diversity of our nation, that those things are connected. Policy and representation are connected. And I hope that we will see sitting before this committee a nominee that pushes us closer towards our ideals of e pluribus unum out of many. One, and I support Senator Menendez and others who have called for a diverse nominee, specifically the fact that we've never had a Latino person serve on the Federal Reserve Board. I think it's a huge oversight, and I hope we can move quickly in that direction. That said, my state of Georgia is in a housing crisis. Like much of the country, the Federal Reserve Bank of Atlanta has designated owning a home in Atlanta as unaffordable to the average home buyer. But this is not just a city problem. Harris County, Georgia, with a population of less than 35,000 sitting on the border of Alabama, is also rated as unaffordable. In the midst of this housing crisis, the Federal Reserve continues to raise interest rates. This makes mortgages a lot more expensive for families, especially young families looking to buy a house. According to the National Association of Realtors, the share of first-time home buyers is at an all-time low, while the average age of a purchaser is at an all-time high. Chair Powell, you have said that there has been, quote, an imbalance in the housing market. But if you're a Georgia family, parents in the mid-30s, young children, and all you want is to be able to afford your first home and place and build equity to one day pass that equity on to your kids, how are the Fed's actions helping that family afford a home?
Our mandate is to provide maximum employment, use our tools to foster maximum employment and price stability. And we're using those tools really now to restore price stability at a time of the highest inflation in 40 years. I think that the same people who are having high mortgage costs, if they have a floating rate mortgage, are also experiencing high costs for all the basic necessities of life. And one of our most fundamental roles at the central bank is to keep price stability. So we have to prioritize that in what we do.
Yeah, I understand the tools and the mandate, but my concern is that we could have a cure that's worse than the disease. It doesn't do families any good if we stabilize housing prices while mortgage rates continue to skyrocket. It doesn't matter to me why a house is unaffordable. Maybe the house is unaffordable. Maybe the mortgage is unaffordable. Unaffordable is unaffordable. How does the Federal Reserve consider the total price of home ownership, including costs of mortgages, in executing that mandate to keep prices stable?
Housing inflation is a very important component of various inflation indexes, and the way that's calculated is the economists look at rents, and then for people who own a home, they impute a rent depending on the value of the home. So it actually does factor in, and I would say the measures of new leases that are being signed and new housing prices show significant declines in inflation, not in price, but in inflation. And that will play through so that overall inflation over the course of the next 6 months or a year will decline.
If we're seeing mortgage rates go up, yes or no, does this discourage folks who may have a low interest mortgage rate from putting their home on the market and then possibly paying double the cost on a mortgage for their new house?
It certainly could. People who are in a low mortgage, a fixed rate, low rate mortgage, I would assume many of them are not moving.
Does raising the federal interest rate change the cost of borrowing for a company hoping to develop new housing?
Yes.
Does it make it more expensive for suppliers to finance expanding production and meet supply needs?
It does.
Does it give businesses less wiggle room to offer higher wages and attract qualified workers?
Indeed.
Yeah. So all of these actions have to be taken into account. Federal Reserve does not control housing supply, but its actions do have a massive effect on housing supply. And some of these supply effects, it seems to me, will be felt for many years, well beyond when interest rate hikes have slowed or rates have even gone down. And I know you've got a difficult job and a tough situation, but I just hope that the Fed will think more about its actions and how they affect housing supply, even as it attempts to control housing demand. Thank you.
Thanks, Senator Warnock. The last question, I believe, questioner is Senator Sinema is remote from Arizona.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today. In raising interest rates last month by 25 basis points, the FOMC cited Russia's war against Ukraine as a key contributor to elevated global uncertainty. The war has serious implications for global energy and agricultural markets. And as you know, energy inflation in particular can appear in the form of higher prices of other goods and services. This feels like a substantial driver of inflation overall. And in my mind, you can't understand the global economy fully without assessing the range of possible outcomes in Ukraine. As we've also seen, the war created new supply chain problems overnight and has caused abrupt price swings in select committees. How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Thank you. At home, Arizona families are struggling to navigate this economy. Higher prices are making it more difficult to afford groceries, gas, rent, and airfare. But on the other hand, rising interest rates are crowding out investment and making it more difficult for first-time homebuyers to buy a home. Inflation has also slowed housing development to a halt in Arizona. And as you know, Chairman, housing is a major economic contributor in my state. It's also clear that more spending comes with trade-offs. And it's why tackling inflation has historically been so difficult. And yet it's more important than ever that we get it under control. There's been much debate about a soft landing, where we get inflation under control without triggering a recession, versus a hard landing, where inflation comes down but triggers a painful recession. Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending, and also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they kind of they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction, and they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Well, thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risks for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or are some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
So we're seeing really, in the last close to a year now, we've seen just a remarkable set of events in the crypto space. Lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think, we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious, and that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC. The Fed has. And they essentially say, you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.
Thank you, Senator Powell.
Thank you.
Thank you, Senator Sinema. We conclude the hearing. The Fed must make sure that workers and families are at the center of every decision it makes to strengthen our economy. We've heard a lot today about the role that Wall Street plays in our economy, too. As you've said, Mr. Chair, we know that higher capital requirements make banks safer and stronger. It allows them to make investments in their workers and their communities and our economy. That's what they should be doing instead of spending billions on buybacks. I look forward, Chair Powell, to working with you to strengthen our economy. For senators who wish to submit questions for the hearing record, these questions are due 1 week from today, Tuesday, March 14th. To Chair Powell, please submit your responses to questions for the record 45 days from the day you receive them. I thank my colleagues for the very, very good attendance today. Only one member on each side was not here, one for health reasons, the other just because he's doing 12 different things. So I appreciate all that, and thanks for your testimony, your public service, Mr. Chairman.
Thank you, Mr. Chairman.
Mr. Chairman.
All right, and with that, let me welcome you to the Halftime Report. Good afternoon. I'm Scott Wapner. Fed Chair Jay Powell, as you see, just wrapping up his testimony before the Senate Banking Committee, suggesting...
All right, you guys hear it. I'm going to go back and I'm going to keep this going a little while and listen to a commentary. Probably hear some drilling in the background. I got some work going on here, so that's why I wasn't going on live, good people. All right, let's hear a little commentary from CNBC about what you just heard, and then I will later post a video later today kind of summarizing it all right? He's been talking for a long time, right? All right, so, yeah, let's just listen.
Basis point hike in March, increasing slightly, but the real story perhaps is the probability of 50 in May was 75% just a short time ago. Terminal rate now in the 5.5 to 5.75 range. So all of this for the Investment Committee to discuss and debate. Joining me today, Stephanie Link, Jim Lebenthal, Carrie Firestone. Of course, our senior economics reporter, Steve Leisman, is with us, too, as he has been watching from the get-go as well. So, Steph, I begin with you. I guess the risk always was even higher, even faster, and for even longer. That's kind of what he said today, is the possibility.
Yeah, and that we're also going to be data dependent, right? And so we have a lot of data. We talked about this last week. We have a lot of data that's coming this week with jobs, CPI, PPI, retail sales next week. That's going to be very important. But honestly, Scott, I don't think a lot of what he said was that surprising. We've been talking about the economy doing better, right? Led by the consumer, and he cited consumer spending. We know jobs have been white hot. They continue to be white hot, which this is why the Friday number is going to be super important. He also talked about manufacturing improving in January, which is a bit of a surprise, right? Because that has been some part of the economy that hasn't been that great. And then he talked about inflation, and we've been talking about inflation whatever way you want to measure it. CPI, PPI, core PCE, unit labor costs. He mentioned services ex housing several times. We know the last reading was a 7.7% rise. So we know that that part of the economy is the problem, and it's going to be harder for them to change that, to be honest. So But I step back and I say, wow, wait, the economy is not terrible, which is what we've been talking about. Pockets not so good. But then I listen to someone like the Eaton CEO on the show earlier today, and he's talking about 85% of his end markets, they expect to see solid double-digit growth in 2023. And that's all because, obviously, infrastructure and the reshoring. And so there are kinds of pockets within the economy that are okay. And those are the areas where I still want to be invested in from a portfolio management point of view.
You know, Steve, I guess you had to figure that the chair was going to be more hawkish today. That was the risk, I guess, going in. It's notable, too, that what Phil LeBeau reported earlier about used car prices and the Fed chair discussing the fact that goods disinflation seems to be slowing a bit and services disinflation is really slow. And therein lies the problem, right?
Yeah, he's just not getting the help. I think it was interesting the way he kind of explained how his view has changed because of the data that we've been talking about almost every day from January. Not only did it come in hotter than expected, but it was those revisions. And Governor Waller gave us a bit of a curtain raiser on how that's affected Fed officials, basically saying, you know, the data's changed, so the outlook has changed. And that's why you get this idea that if the data remains the way it has been, when the Fed goes to pencil in a new terminal rate in March, it's going to be higher than they previously put in there. And I don't think the market was quite prepared for that. I think they were prepared for the idea that it could be higher. But what it wasn't prepared for is the idea of a more rapid pace, the idea they go back to 50s. And Scott, I just want to go through, it's a little complicated, guys, but if you could put up the probability changes that we've seen, what's happened now is you have, and I'm going to put my glasses on to look at this, Scott, 56% probability they go up to 5.25, and that's more than double the percentage it was before the speech. And then a 93% probability you go to 5.25, 5.5, 71% probability you go to 5.5, 5.75. You can see all of those percentages are substantially higher. So what the market has now baked in here, Scott, is, as you said at the top of this segment here, higher, longer, and perhaps more rapid. He just said again that if the data continues to come in the way it's been, we could get there more rapidly.
Because, Jim Lebenthal, you got a couple of problems. You got the economy is hotter than the Fed chair wants it, and disinflation is slower than he needs it, which is why we just had this conversation with Steve, and the chair said what he did today. That's not a great message if you're touting all of the bullish things you see in the stock market for reasons why equities can continue to advance even in the face of everything the Fed's doing.
Scott, that's an excellent assessment that you just said. My qualification to it, I hope you'll allow this, is that we were in a different context, a different sentiment about 5 weeks ago after the last Fed meeting, right? Remember, that's when he started talking about disinflation, and disinflation started to hop up in the media hits. It was 2 days later you got that labor report for January, and then you had 4 weeks of January data that was just not good. It was not good, and it really did blow a hole in the disinflation theory. The problem is, I don't know, and you don't know, and nobody knows if January is an aberrational blip. Let's remember that 3 months prior to that, October, November, December, you had good inflation, better than expected inflation.
Not necessarily from the services side. That's the part that you haven't.
Let me come right back to that.
Well, it's the most important point.
Okay, but let me.
That hasn't cooperated with you.
Let me get right there. Okay, but let me just say we don't know if January's numbers, which is all that the Fed has in front of it right now. When he speaks right now, Powell is focused on January's numbers. We don't know if it's an aberration or a blip. We need February's numbers, which starts this week with average hourly earnings.
Jim.
Then you get CPI, PPI. Steve, give me 1 second because I want to address Scott's point. It's a very good one, okay? I understand we are looking at this granularly. The Fed is looking at this granularly. Services, ex-shelter, core ex-shelter. I get it. But you have to understand, as much as he doesn't want to admit it, the Fed is a political beast. And if you get headline CPI, which is what I'm talking about, if you get it moderating, that's a big if, okay? But if you get it moderating, the Fed is hell-bent for leather to crush jobs, while CPI headline is moderating, that's going to be a political problem for them.
Steve?
Just real quick, I want to correct the idea that it was just the January data. Scott Wapner, the judge, is very good at calling people on the carpet. He's never called me on the carpet for my about face on this. And what happened, Jim, was that I was relying very much on the precipitous decline in the 3-month inflation rate. That was pretty much revised away. And that's really for what's going on. It's more than just January. If it was 1 month, Jim, I'd be on board with you. And maybe it ends up going away again and we get better in March. But it was more than just January. I did an about face on thinking the Fed was doing way too much. And now I'm thinking they're in the right place because of those revisions.
And how does it make you think about where we go from here?
Well, it was definitely somewhat of a surprise when the market's down. The market didn't go up, and it moved down pretty sharply, although I see it coming back a little bit. Here's what I suspect he's addressing, and I'm concerned about it as well. We should all be. He referred to services several times in the testimony about how the service economy, it's more than half of the U.S., and it's very strong, and people are spending money on travel and on restaurants and experiences, and we know that consumer debt is going up. And I think that if I were in his position, the way to control that, to try to get some of that debt to come down and stop building up a point at which we could have consumer defaults, is you've got to raise rates a little bit more than expected, and people.
I 100% agree. Rip the Band-Aid off, raise rates a little more than you are doing right now, and just get this dog and pony show over. Look, it's gonna hurt, good people. Either way it goes, it's gonna hurt. The longer we kick the can down the road, the worse it's gonna be. That is the fact. Let's look at this. I was pointing to, as soon as he got through speaking, we could see the indices, all of them started to tick back up. All right. I'm going to leave it right there, good people. And I'm going to I got work going on here. I'm going to try to dissect a little of this and give a later video just updating everything. OK. All right. We'll see you later on the day. All right, good people. For those of you that are at work, I just wanted to just give you a little peek into what's going on while y'all on your phones while y'all working. But that's cool because we trying to make money while we work. All right. Catch you guys later.